Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're going to be talking about a new SPAC to the channel, but one that actually has been covered a bit on YouTube before. However, a lot of the videos I've seen haven't addressed it in full detail. I've missed out a couple of really important things that if you're considering investing into this company, then you definitely want to be thinking about. So the SPAC we're looking at today is BFT, and it's the SPAC led by William Foley and the proposed merger with Paysafe. In this video we're going to cover absolutely everything you need to know about BFT, what Paysafe actually do, what the SPAC does, what the positives are, and as we always do on this channel, we'll talk about the negatives and address the possible mitigants of those. And at the end, I'll also conclude on what I'm doing and why. Now, as I mentioned a second ago, there are a couple of really important things that you definitely want to be thinking about if you have invested or if you're thinking about investing into this SPAC. So this video is definitely for you. If you're new to the channel and you like investing related content, then hit that subscribe button. And if you like this video, please smash the like button. Now, I typically find when I do a video like this and I do address some of the negatives and some of the potential risks that the businesses face, that actually I get a disproportionate amount of dislikes. If you're going to be a good investor, you do need to think about the risks and the negatives and the potential mitigants to those. So it is so important. So please smash that like button to help offset the number of downvotes that I'm likely to get on this video. As always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So what does Paysafe do? Well, ultimately, Paysafe is a payment processing business. They have three main revenue lines. The way this works is ultimately when you have an account on a website, say a betting website for example, and you load funds into that, you have a specific part of the website which is your wallet, the amount of money you have in your account. Paysafe's role here is managing the payment transfer from your card into the digital wallet and managing the digital wallet. The next part of the business is the eCash side of the business. Now simply, this is typically when you have an account in a game, for example, and you use real money to buy a digital currency. Examples of this are quite common in video gaming, for example, where you use real money to buy skins, or where you may acquire gold or points, and keep those in a wallet to use them to buy things to benefit you in the game. Another example could be FIFA points, for example. And the third part of the business is integrated processing. Very simply, this is when someone runs an online store, it enables the merchant to take payment in various card types and receive the monies. So in a nutshell, those are the three main things which Paysafe does. So what is BFT and who's William Foley? Well, firstly, William Foley is an industry veteran, highly decorated, great track record of going into businesses and implementing a turnaround or a value creation plan. He's done it a number of times and you really can't argue that he knows what he's doing in these situations. He's ultimately leading the SPAC and he'll be the one in charge of delivering this plan with his team. Now, an important thing to note at this point in time is that actually as part of this transaction, there will be around a $2 billion pipe. And what's more, the pro forma shareholding post-completion of the merger will mean that the current shareholders, Blackstone and CVC, will hold just under 50% ownership of that entity. Now, this is really important to bear in mind, but we'll come on to why a bit later in the video, so keep that in mind. So, what are the positives? Well, there's really a lot to like here. First of all, let's talk about the market. It's a high growth market with a lot of tailwinds behind this. The business does have a focus on a number of really attractive high-growth verticals: online gaming, esports, video gaming. These are all verticals which are forecast to experience massive growth, so it's great that Paysafe is aligned to those. What's more, the acceleration of the trend and the shift to online retail and online transactions, in part catalysed by the ongoing health crisis, provides even further great tailwinds for the business. In this situation, you also need to think about the demand. Now, the demand from its customers is absolutely mission critical. Taking payment and making revenues from its customers is ultimately the primary reason why that business exists. So its customers cannot be without the ability to take payments, and so they need a payment processor for that. Ultimately, whilst the differences between different payment processors is actually fairly limited, typically the observation seen in the market is that actually customers are fairly sticky. The benefit of switching payment processor is so limited versus the massive risk of switching provider and have something go wrong. So that here is a great dynamic to see. Sticky customers with limited propensity to switch provider. Another real positive here is that there's actually real strong barriers to entry here. It's really hard for new payment processing businesses to get a foothold in the market. The market has a lot of regulation, there's a lot of scrutiny on it, and ultimately it becomes very hard for new businesses to enter the market. Ultimately, the regulatory side of it does also drive an efficiency that comes from scale. Now, that's a really important point to also keep in mind, and we'll touch on that in a second as to why that's a real benefit here. Now, the next positive is the team and their experience. Can't argue with it, they have a great track record. They have in their track record delivered a number of challenging and impressive value creation plans. So seeing that alone makes me positive that this team are probably one of the best placed to try and do this with Paysafe. When you look at the plan outlined in the investor presentation, it's clearly had a lot of thought put into it. Now, whilst it's an area I need to do more work on, I have looked at each of the pillars of growth they've outlined, and I do agree, I think there's a real tangible opportunity there for them to go after. And ultimately, I think that plan does all make sense. Now, as is always the case with these investor presentations, you do have to remember that ultimately this is a sales document, and so whenever I'm doing analysis on opportunities like this, I will always apply a haircut to that management plan. So having haircut their plan and looked at it in that way, I still think it makes a compelling investment opportunity from that perspective. Now, the next thing that really excites me about this opportunity, and which I haven't really seen covered that much on YouTube, is the M&A opportunity, the acquisition-led growth strategy, buying other companies and scaling up that way. So yes, obviously the one great thing about this is that it actually allows you to accelerate the growth. It allows you to access to new customers, which are sticky, we know that, and unlikely to switch, access to new verticals, end markets, and geographies. But personally, I think the most exciting part comes when we think about what we mentioned earlier and the benefits that come from scale. Now, I have touched on this concept briefly in another video before, however, I'm going to go through it again. Ultimately, it's the concept of value creation through multiple arbitrage. Now, that makes it sound a lot more complex than it really is, so let me talk you through a fictional example to help you understand that a little bit. So assume Paysafe can acquire Company A, which is a payment processing business doing 10 million of revenues for 3 times sales. Now, for smaller businesses, that's a very fair valuation. Smaller businesses typically trade at a discount on a valuation multiple basis to peers. So acquiring that business would ultimately cost around 30 million. That business is acquired and consolidated into the group. However, the overall group is trading at, say, 10 times sales, which ultimately means that 10 million of revenues is now worth 100 million. Which ultimately means that 10 million of sales is now worth 100 million. So to increase our value by 100 million, all we had to do was pay 30 million. That uplift in value creation or multiple arbitrage is really common in strategies where there is an acquisition-led growth strategy. This value creation strategy or multiple arbitrage strategy is very common in sectors where there's a great degree of fragmentation and where there's real benefits of scale from being larger. Now, that's not at all where it stops. There's still more exciting things about this part. So when you acquire Company A, there'll also be a number of real cost-saving opportunities which you can make. For example, certain functions will be replicated across the business you've just acquired and your business. For example, the finance function. Various other costs and subscriptions that may be being made. Regulatory costs, for example. So when you consolidate the company into the group, again, you can generate synergies or cost savings, which again drive further value creation. Personally, this is the part of the strategy that really excites me. What I also like about this SPAC is the fact that it has a proven business model. It has a historical track record of delivering good financials, positive cash flows. Typically, I don't like investing in businesses which don't have that proven business model, which don't have the historical track record, and ultimately where there is a much greater execution risk. Here, there isn't that same execution risk in the sense that the business is proven, it's working, it is a market leader, and I like that. So, what are the negatives then? So look, to be a good investor, you always have to address the positives and the negatives. And when you look at the negatives, you have to understand whether the mitigants are sufficient for you to make an investment into this business. No investment opportunity has no risks, and ignoring them just means you're not a good investor. Now, as I see it, there are some good mitigants to the main risk. However, there's one risk that is pretty big, and ultimately that dictates partly how I'm going to play this opportunity and what I'm going to do. And I'm going to save that one for a minute, so bear with me. Now, firstly, the risk I see is the failure to deliver on the growth plan that's outlined in the investor presentation. Now, clearly, the plan outlines massive growth. Foley and his team really need to be on the ball to deliver this strategy, and it's not going to be easy. And as with everything, there's likely to be hiccups along the way. However, for me, I don't see this as a massive risk. As mentioned before, whenever I'm looking at these things, I always look to haircut the management case. And having done that with this opportunity, it still makes sense from that perspective. So personally, I'm not overly concerned by this risk. What's more, their track record speaks for itself. So if you're going to trust any management team to do it, I think this is one to do it with. Now, the second risk I want to talk about is the resilience of the business. Now, if you've seen any of my other videos, you'll know how important resilience in the company I invest into is. Long term and through economic downturns, it's proven that actually the companies that demonstrate the greatest resilience are those which generate the greatest shareholder returns. And especially where we are potentially in the economic cycle now, that's why this should be of particular importance to us. Now, ultimately, yes, whilst the demand for the product is mission critical and it's a B2B business, so its customers aren't going to decide not to use its services because ultimately that would mean they'd go out of business, what we can't get away from is the fact that the revenues are linked to transaction volume. This is an area where I still need to do more work, and I need to understand the end market focus and the potential impact of a slowdown on those. However, I'm pretty sure that families look to put food on the table first before buying new Fortnite skins. So we can't get away from the fact that a lot of the customers that they're serving, their end markets rely on discretionary expenditure. And as we know, in an economic slowdown or recession, discretionary expenditure slows down. However, this is an area that I'm looking to do more DD on myself, and as and when, if there's interest, I get more information on this and do more analysis, I'll share it with you. Now for me, this is the real big risk and the real concern I have. We mentioned it before, but it's in relation to the size of the pipe and the nature of the shareholders, which will hold just under 50% of the business. Now, many SPACs this year face the challenge that post-completion of the merger, there has been a dip in the share price, and that has been driven in part by the fact that a number of the PIPE investors have sold their shares following the lock-up period. In this situation, there's no escaping the fact that the PIPE is $2 billion, and on top of that, on the basis of the $10 net asset value, the value of the stake held by CVC and Blackstone is around $3.2 billion. Now, we need to think about who Blackstone and CVC are. They are private equity funds. Now, their business model is to invest in private companies, not those listed on the stock market, take a controlling stake, take board seats, and drive value creation within the business over a period of 3 to 5 years typically. The model doesn't support longer term investments than this, and typically, and importantly as well, the model doesn't support and they're not meant to be holding stakes in listed companies. The way these funds make money and the way the investment team are remunerated is on the basis of exiting these investments. So ultimately we can be pretty damn sure that they're going to want to sell their stakes fairly soon. Private equity funds don't like the volatility that comes in valuations from holding public companies. Yes, I know some people will point out that both CVC and Blackstone do have certain funds dedicated to making investments in public companies. However, those are different funds. Different investors have invested within each of those pools of capital, and ultimately the capital that they've done these deals from comes from the buyout funds, so they will be looking to exit those. So for me on this point, it's essential to understand really clearly and in detail the lockup period that's applicable to both of those parties, both the PIPE and CVC and Blackstone. I'm fairly sure for the latter, at least CVC and Blackstone, that once they're allowed to sell, they will. So this is something that I'm going to look into in detail and ultimately does drive the decision I'm going to make about my investment into this opportunity. So that leads us quite nicely onto what am I doing here? Well, ultimately, I like the opportunity. There's a compelling market opportunity here and there's attractive dynamics. There's a strong management team which have a good track record of delivering strategies similar to this. And ultimately, I don't think the valuation is particularly crazy. If you look at it on a multiples basis versus the valuation which CVC and Blackstone paid when they first invested into Paysafe, it's pretty much in line. And given how we've seen valuations across the board in the market increase over that period of time, I'm actually fairly comfortable with this. For me, however, the main concern is the fact that actually I think we're going to see a fairly meaningful decrease in valuation when the lockup period is over. So on the basis of this information, my plan is to make a small speculative investment at this point in time, with the plan of exiting that completely before the expiration of the lockup period. I'll then monitor the opportunity closely, see how the market reacts and see what happens with those shares being sold. And once I'm comfortable with the fact that CVC and Blackstone have exited and I feel that the price is settled, if the long-term opportunity is still as compelling as I see it to be now, then perhaps I'd consider reinvesting. And if you've seen this channel before, you know this strategy is actually fairly uncommon for me. I don't like to trade around catalysts. However, I like the opportunity here. But what concerns me is the amount of shares in the pro forma shareholding held by investors who are likely to sell quite quickly. So look, thank you so much for watching. I hope you enjoyed it. If you did, please smash the like button. If you're new to the channel and you like investing related content, then smash that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. There's always some really interesting debates, some really interesting perspectives put forward, and I love hearing those and getting involved in those. So please get involved. But thank you so much for watching, and I'll see you in another video.